I'm Marty Coyne, and I'll be the moderator for our Compensation Committee webinar today. And thanks for joining us to hear more about what new compensation issues will emerge in 2019. Now, from a Compensation Committee point of view, it would be wise to expect that next year will be as full of uncertainty and change as this year has been. You know, our boards have weathered massive tax reform and the CEO pay ratio, and overall there's been a resurgent interest in gender-based pay issues. 2019 is likely to bring a new wave of concerns, such as the proxy advisors turning their focus on director pay, board diversity, and new pay for performance metrics. So we have two very highly experienced executive compensation experts with us today from Pearl Meyer's New York office, Deb Lachey and Leanne Richardson. And they'll kick off our discussion with a quick review of recent proxy advisor positions, and then outline 5 important on-the-radar compensation issues that are likely topics of discussion in your 2019 committee meetings. Now, before we get started, Sienna Bream with NACD's education team will take us through a few brief housekeeping items. Sienna?
Thank you, Marty. Audience, I have a few housekeeping items to share with you today before we get started. On the right-hand side of your webinar console, you should see several boxes. At the top, you can submit a question to be answered by our speakers during the program, time permitting. If we have a lot of unanswered questions, our speakers may also follow up with you after the program to answer your question. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. Also on the right-hand side of your console, you can tweet live with us using @NACD and @Pearl Meyer. And in the bottom right corner, you can download a copy of today's slide deck, register for our next webinar, and access additional resources. You will automatically receive 1 NACD skill credit if you participate in this webinar for at least 30 minutes. Credit may be applied to NACD fellowship programs, and you can contact fellowship@nacdonline.org for more details. Please note that this is for the live program only. You can download a copy of today's slide deck through your webinar console, like I mentioned, or at pearlmeyer.com using the link on your screen. Also, a recording of this webinar will be available early next week at nacdonline.org and pearlmeyer.com at the links on your screen. Finally, we will have a few anonymous evaluation questions at the very end of the program, and we would appreciate your feedback, so please stick around at the end of the webcast to answer those questions. And now I'd like to turn it over to Deb to get us started.
Thanks so much, Sienna, and thank you all for joining us today. You know, we do this program annually with NACD as a sort of a year wrap-up, looking forward to the year coming up. And usually we have some big events that drive what we're predicting for the following year. We have some really pivotal ISS or Glass-Lewis change, or last year we had tax reform and CEO pay ratio. But this year is a little bit unusual because we didn't have any large driver of change. But that being said, we are in a time of change. The economy is in flux. We are very turbulent in terms of politics, tariffs, trade wars, and companies really need to plan for the uncertainty. But it's not all bad news. The fact that we don't have a lot of regulation driving decision-making and compensation setting really offers all of us a chance to step back and say, how can we design compensation in a more creative and perhaps strategic manner than what we've done for the past years when we're really kind of boxed in by regulation. With that, today's agenda, quickly on our overview, will include a quick regulatory overview of, as I mentioned, very minimal changes for looking forward for 2019. Leanne will cover the changing and expanding role of the Compensation Committee. We'll look a little bit at director compensation structures and how we might get a little bit more creative around how you all are being compensated. Then we'll turn it over to executive compensation, focusing on what's happening with TSR as a compensation measure. On the flip side, we'll also talk about some non-financial metrics and how those are influencing pay. And to wrap up, we'll talk about how should we plan for the unexpected in times of change. So our first topic, regulatory review. No discussion about compensation looking forward would be complete without seeing what ISS has gifted us at the end of the year. The first thing to note is that the thing that many of us focus on is the pay for performance test, which is the quantitative and qualitative test that ISS applies to see whether or not they will vote against or make recommendations for, say, on pay, compensation committee members, and other directors. This year, there was not a change to the pay for performance test. In the policy survey and in some proposals, ISS had suggested replacing the component of financial performance measures, return on interest, return on assets, return on equity, EBITDA, and cash flow that had been applied for the past few years in addition to TSR. And they suggested replacing all of those in 2019 with EVA, economic value added tests. And that caused a flurry of uncomfortable reaction from a lot of people, investors included, because right now there are not very many companies that actually use EVA as their primary driver in executive compensation programs. And so we provided commentary, and in reaction, at the 11th hour, ISS retracted from its initial position and said, no, we're not going to use EVA as a measure of the pay for performance test this year. We reserve the right to use it for 2020, but this year we'll only mention it in the reports, and we'll stick to the parameters of the test from prior years, your financial performance assessment combined with your TSR. The other important change, particularly for this audience, is that ISS a few years ago proposed that it would vote against boards and committee members responsible for director compensation where there was a recurring pattern of 2 or more years of excessive director pay. Excessive was loosely defined as being somewhere in the top 5% of comparable companies. The problem was ISS never came out with a definitive methodology that showed us how to apply this 5%. Were we comparing director to director? What was the peer group? Or were we comparing director compensation on the whole to aggregate director compensation? And so this test was supposed to come into play in 2019, but we had no guidance throughout 2018 as to how to apply this test, and therefore no guidance as to how to structure to meet the test. As a result, again, at the 11th hour, the ISS came back to us and said, we're going to take another year to think about this methodology. We won't issue adverse voting recommendations in 2019. We're going to put it off until 2020 when we have a more transparent methodology. So that was a welcome relief. There were some minor tweaks on the equity plan scorecard, which is a test that ISS uses to assess whether or not it will vote in favor of equity compensation plans to shareholders. Minor tweaking about passing scores. They're putting in an additional override factor looking at dilution of above 20% at larger companies and above 25% at the Russell 3000. And they tweaked the change in control vesting language. ISS is very sensitive to windfalls and equity vesting if, in fact, an executive stays with the company following the change of control. So you have to have some very particular wording in your plan at this point to get full credit on the change of control factor. Similar to ISS, the Glass-Lewis changes were really minimal this year. They refined a lot of their policies. They said if you put in any kind of 280G, golden parachutes for any of your executives, we'll likely issue a negative vote. They had some minor tweaks and negative things to say about contractual awards. They don't like sign-on awards, front-loaded awards, overly broad change of control triggers, severance payments that are sort of out of line with market practices, and discretion in incentive compensation plans. But when you read their policies, Glass-Lewis is a little bit more forgiving because they say, we realize these types of practices happen. If you have some fulsome disclosure, you explain why these things were necessary, perhaps we won't issue against recommendations. And lastly, ISS said that, Glass-Lewis said with respect to clawbacks, they want to see something a little bit more particular and demanding than the bare minimum needed under the proposed Dodd-Frank regulations. So there you have regulatory review from the proxy advisors in a nutshell. No discussion of compensation would be complete without discussion of tax reform. Really, the big hit came at the end of last year when the new tax law eviscerated the 162M tax deduction. And, perhaps this has set the field for what we're talking about today, which is more flexibility and creativity, because now, of course, except for grandfather arrangements, we're not boxed into the 162M parameters awarding incentive compensation in order to get tax deductions. So we'll have a little bit more flexibility on that front. CEO pay ratio, of course, we've done a whole study in conjunction with NACD about the impact and what happened, and it was really a bust compared to the boom we thought it was going to and the firestorm we thought it would create last year. Very little reaction to the pay ratios, and most investors just plain didn't care. Things you'll need to think about in year two, generally speaking, you'll use the same median, and identifying the median, for those of you who are in the thick of it, was really the toughest part of the exercise. You'll need to take that median employee and see if there were any material changes in either your overall workforce or compensation programs. If there were any material changes, you'll have to identify a new median employee, but it shouldn't be too much trouble assuming methodology remain the same. You want to address things such as if there's a material swing in CEO pay due to mega grants this year or last year that then results in a much different pay ratio, you might want to address that in your disclosure. You don't want to be at this point changing your methodology or trying to talk about how you compare to your peers, because no good will come of it. And as we've been saying since 2010 when this was all proposed, there's not much value in this ratio, so why call attention to it? So really be consistent in year two analysis, and remember that even if you don't change your median, you want to state that there's no reason to change your median. You're using the same median. We're simply updating the numbers for 2018 compensation. So there in a nutshell is everything regulatory, at least on the compensation front, that we thought was significant to point out this year. And now I will turn it
Great. That's a really good summary, very quickly and very succinctly done. So let's go to the first polling question. We've got two of them in a row here on EVA because this is a looming issue. So please take a look at this on a scale of 1 to 5, with 5 being not at all effective and 5 being extremely effective. How effective do you all think that an EVA metric would be as part of your company's incentive plan? So that's the first polling question. Fill it in if you could. We'll give you about 15, 30 seconds to do it. EVA has been a very, very interesting issue for many, many years. I can remember being on the operating side, and our company at the time wanted to do EVA, and I've been on other discussions since then. Should it be part of compensation for companies? And so there's major issues around EVA in terms of understanding from the employees and the executives exactly what role they play, how's it calculated, what are the assumptions, et cetera, and making it all work. And so it's going to be a real challenge if ISS pursues this aggressively. Let's see what the results are. There we go. Okay, so it's kind of a mixed bag here, right? Where about 40% say it's kind of neutral on it, and about 30% or so, 35% say not at all effective. Very few of us right now believe it's extremely effective. And so it's going to be interesting as this plays out over the next year or so with ISS and the reaction they get. So let's do one more question on EVA before we leave it. If you're going to have good comp discussions this year, what do you think on, again, a scale of 1 to 5, how likely are you to use EVA as a metric in your incentive plans if ISS adds this to their financial performance assessment? And this is in many ways kind of like the early days of TSR when we got some pressure on comp committees to add TSR, and we struggled with it at the beginning. Again, the issue that I've seen with this is, with all comp plans, is if you can't, if the executives and senior management, and then you get down into the mid-management level, cannot understand how they're being measured and what the real objectives are here and how it ties to strategy, sometimes the best comp plan in the world is for naught. So, again, let's see what the results are if you're going to use it, if they mandate it. And bravo. As a comp committee member, half of you are saying very unlikely. It's going to be very, very interesting to see how this one plays out. I suspect, Deb and Leanne, if we went back into the early days of TSR, we probably would have seen the same set of results as these in terms of the willing acceptance of comp committee members to embrace TSR in those days, now EVA. So it'll be interesting to see how this plays out, as we go forward.
Right.
Yeah. So interesting. So we got to pull these up in a future webinar, and you'll see how things change over time. So, Leanne, let me turn it back to you to talk about the first big topic of the day, the changing role of the Compensation Committee, because that's really, really critical.
Thanks, Marty. Okay, so we thought we'd start off today with how comp committees are actually doing more than just compensation. So, spending more time on non-compensation and more human capital issues. So we have a few data points for you out of last year's NACD Director of Compensation Research. So last year for comp committees, we went back to see, hey, what is the actual name of the committee, and looked for prevalence of companies that had changed their committee name to reflect a broader agenda. So, is it the Human Resources Committee, the Compensation and Leadership Development Committee, is it the Compensation and Talent Committee, and so forth? And what we found is that, out of the 1,400 companies, about 20% had renamed their committee to reflect something that was broader than just compensation or executive compensation. And likewise, fast forward, in a recent Pearl Meyer on Point survey that we run, there was a question about, what other issues does your comp committee have responsibility for? And, there were several choices. And when you looked at how many companies had checked the boxes that said, hey, our compensation committee also is responsible for succession planning or talent development or even corporate culture oversight, 41% of the companies said, hey, we're doing more than just your traditional compensation. And so on the next slide, we listed 3 broad areas where we're seeing compensation committees, push out their purview. So the first category we're seeing, we're pushing down lower into the organization around more broad-based issues, and most notably those that have come up in the area of, the CEO pay ratio. And again, we've all said, hey, didn't get a lot of attention in year one. Deb and I have been chatting with a lot of our colleagues about this, and many of us believe, this doesn't necessarily mean it's not a big deal. We just think it means year one, people were trying to figure out what to do with it. We think the story is not totally written yet. In fact, we may see more attention in year two, especially when you start to have the ability to kind of track year-over-year changes to both the top and bottom numbers. So it'll be interesting to see how do companies explain why the CEO's pay went up 20% and the median employee pay went up only 2%.
Right, and Leanne, if I could just jump in, we were in the weeds with a lot of clients on the first year of CEO pay ratio. What we saw is the committee members were really not that involved until the end. It was more of a regulatory exercise. Let's meet the requirements. Let's disclose how we did this, and then the ratio is what it is. Now the committee does have the opportunity to get a little bit more involved in looking at how they did compare to peers and how you might want to choose to explain whatever you need to explain in terms of changes this year. So it's a little bit of a more substantive issue for the committees this year.
Right, and actually, Marty, maybe how involved were you with the CEO pay ratio?
It was oversight of an excruciatingly laborious is the best way I could describe it. Because it really, in one case, it made no sense at all, just because of some of the circumstances. In the other, it was a theoretically interesting thing to do, but by every other benchmark we had used was not an issue at all.
Okay. So again, it'll be interesting to kind of see where we end up, this year again.
Yeah.
But and so yeah. Aside from the CEO pay ratio kind of topic, one other area I wanted to finish with this first category, with its broad-based issues is, the whole gender as well as other diversity-based pay equity issue. And, historically, gender and other diversity-based pay parity hasn't really risen to the board level. HR has been in charge internally, if and when there was a concern. And while legislation and debate surrounding gender pay parity isn't new, 2018 certainly brought, a renewed focus to the issue, and, we believe this focus, will continue through 2019. With that said, while gender-based pay parity, is the hot topic of late, and more directors are asking about this issue, I'll just throw my 2 cents in here. To some degree, I don't think this topic is coming up as much as it should. I think there may be some, restraint because some feel that bringing up the topic implies that there's a problem. But, in reality, we think it's just really good governance. So just asking management, have we looked at this yet is an easy place to start. So consider, putting this topic on the next committee meeting agenda. Ask the management team and HR the following questions. Have we taken a look at it? Do we have any issues? Have we had any problems in the past? And if so, how were they addressed? Do we have a game plan for incorporating this into our compensation and talent management structure? Moving on to the second category, so where we're seeing compensation committees kind of push out their purview is related to succession planning and talent development. So as many of you know, many committees have been doing leadership, talent management, succession planning for years, have included these topics in their meeting agendas. However, where this may have come up at maybe one meeting during the year, we're starting to see these topics come across, maybe even now at multiple meetings, or at least raised in some sort of fashion during each meeting. Also, as we look at the increasingly tightening labor force, you start to think about whether or not, we will start to see a new war for talent, which requires, companies to have a little more focus on succession planning, talent development, and how do we create, the retention hooks to keep our best people. And then lastly, a lot of the culture-based issues that we've seen, how they intersect with compensation, other human capital type issues, whether it's the Me Too movement, the whole issue with Wells Fargo or Volkswagen. Certainly there was a sense in Wells Fargo that people felt it wasn't entirely caused by compensation, but the compensation, clearly didn't help matters. But I'm sure we can all think of a ton of other examples that were more people-related, but not necessarily compensation-specific, where, we've seen the compensation committee get involved. So now what? Let's just talk about some practical takeaways. Charter. So whether or not, your committee changes its name or not, or whether your committee's purview isn't or isn't expanding to include any, none, or all of these items, we think it's a good idea for companies to revisit their committee charter. In fact, if your company is not already doing so, we recommend that compensation committees revisit the charter on an annual basis to really discuss and ensure what falls, and actually just as important, what doesn't fall under the purview of the committee is accurately reflected in the charter. Proxy disclosure, obviously an update what the committee covers, and as we discussed, this new focus on retention, talent development, and succession planning, to the extent that the company has provided any special awards or retention hooks to keep its people, and it impacts your top 5, make sure to include the rationale behind those awards. And then finally, kind of the impact on director compensation. This is more of a rhetorical question, but knowing that the purview of the committee is expanding, will we see an impact on director compensation levels, structure, overall, some food for thought. There are some competing trends where, what has historically been the case is the audit committee gets paid more, than the compensation and the nom-gov, since, there's a sense that they're the workhorses, they have to go through all the data, and yet we're seeing now the comp committee has additional things on their plate around all these broader company-wide issues. So will we see the compensation committee pay drift, even closer to the audit committee? And likewise, you see, the nom-gov dealing with, more things as we start to focus on director demographics, refreshment, identifying and onboarding new diverse directors. So, more to be done there too. So, it's this interesting kind of, byplay around committee work is getting more complicated, not just for the audit committee, but for the other 2 standing committees. And on the other hand, we're seeing kind of this additional scrutiny of director comp from ISS and Glass Lewis in the future. And, even one more thing, where we've seen kind of a trend where, the committee member compensation is kind of being rolled onto the board retainer to streamline, right, how directors are paid, in the same form, so in the form of a retainer. So it's just really interesting to see what happens in 2019 and beyond. So just to throw that out there, but, which I guess is a great segue to my colleague on our second top 5 topic.
Thank you, Leanne. That was great. Much to the chagrin of, I suppose, this audience, I will not be telling you should all get raises and what the standard increments were for this year. Again, we do a report with NACD where there's a lot of data and statistics about that. I think that the purpose of this segment is really to talk about director pay at a higher level in light of all the external forces we're seeing this year. I mean, of course, market practices, what your peer group is doing is relevant. What's happening with ISS and Glass Lewis, and particularly ISS test at the 5% excessive level will come into play in 2020, so you'll need to be mindful of that. But an even broader look at directors generally, there's an extreme focus by all constituencies on board diversity. As you know, in 2020, ISS will recommend against the nom-committee chair and perhaps other directors involved in a nomination process if a company has no gender diversity. Even more imminently, beginning in 2019, Glass Lewis will be recommending against the same people if there are no female directors. Of course, Glass Lewis also says if you explain why you have no diversity and your attempts to put a program in place to expand diversity, they might give you a pass this year. But nonetheless, it's out there, and we need to start thinking about these issues. Other issues that committees are talking about board refreshment, how do we get young talent, how do we get them educated, and as Leanne talked about, what are their additional responsibilities, not only on the compensation committee, but other committees with the changing environment. So on the next page, what I did is you could read all these suggested changes, but really I think what we're getting at is how can we think about a director pay in a way that gets away from the fairly rigid patterns that we've seen historically? And how can we do this to structure the pay to help facilitate some of the diversity and change we're looking for and the transitions we seek in board demographics? These are some ideas. They are not all new, novel concepts that are mind-blowing. A lot of them, in fact, are a blast from the past because we might have seen them a few decades ago, and maybe now's the time to start thinking whether strategically they won't be making a comeback. One thing we've been talking to some committees about is whether there should be more flexibility for directors to self-select between cash and equity depending on their needs at the time. Of course, this begs the question of what will happen to share ownership guidelines and requirements at that point, and so those issues will need to be addressed. One other creative idea we've been thinking about is maybe costs for director education are built into the pay package so that it enables directors to go out and get up to speed quickly and maybe recruit different directors with different skill sets. It might encourage directors to seek that education more if it's built in the pay package rather than just having an election and a reimbursement, which is what we've seen in the past. This is a sensitive topic and one which I hesitate to bring up with this audience, but because you can't reach out and hurt me, I will raise it. But people have been thinking about board refreshment and retirement, bringing in new talent, and helping transition some of the directors that might be there for a while. You know, years ago, director retirement programs were in vogue, and they went out of vogue very quickly with some of the proxy advisory comments, and nobody really wants to see director retirement plans come back, but maybe there's something we could do in the package that encourages a healthy amount of turnover when it's needed to bring in new talent and obtain the objectives that the outside forces are bringing on us and, you know, government standards today. Some companies have been talking a little bit more about sign-on grants for younger directors or directors that may need to come up to speed on their share ownership guidelines very quickly. We used to see that it's fairly common practice in some industries, haven't seen it in a while. But of course, if you do this and then a director pay is sort of on the excessive side because you're a new director, you'll need to provide a lot of disclosure in your proxy to let ISS know why you might be failing whatever test they come up with. So I think the point of all of this is maybe it's time to start to think about director compensation structure in a more creative fashion. And we certainly don't want to get to a point where every director has their own deal and we need to administer it, negotiate it, but maybe some one-offs are needed going forward in order to achieve the goals that we're all talking about now in terms of governance. So we're thinking 2019 might be a year that companies are asking themselves how to get creative on this front. Marty, have you seen any kind of, on the boards you're sitting on, any kind of interesting pay packages or suggestions coming up around this issue?
Nothing interesting. It's basically, an equity grant for new directors starting off. I haven't seen anyone being compensated for education expenses, although most of the boards that I've been involved with have always given directors whatever, compensation for attending NACD classes or other director education events, so that's not an issue. In reality, I think as you think it through, you got to keep it as simple as possible and as straightforward as possible, because the CDA is already complex. People are already looking at our compensation as compensation committee members and board members, and so you want to keep it simple, direct, and easy to understand, whatever you do, because complexity here might make directors feel better, might think we're being rewarded properly for the time we're putting in, but might confuse the investors and raise all kinds of other issues, unintended consequences. So,
good point. Well, with that, we'll now turn from board and director compensation over to executive compensation. I'll hand it over to Leanne to talk about our favorite or measure, TSR.
Thanks, Deb. All right, so this topic actually draws on a blog that one of our colleagues wrote earlier in the fall, which focused on oil and gas and cyclical industries, but we felt that the general theme applies to a lot of companies across industries. And the general theme is, for a lot of companies, no matter what you think about total shareholder return, it's going to be a part of your program. Either it works for you because of your industry, or you have to make it work because your shareholders like it, or your board likes it, and so it's not going away. We all know, relative TSR plans have some well-known drawbacks, right? So, including the fact, TSR is not a strategic measure, concerns regarding line of sight, and relative TSR plans don't necessarily help drive any specific behaviors. But despite this, and trends towards, companies seeking alternative or supplemental measures to pair with relative TSR, it does remain, one of the most, common long-term incentive plan measures for, named executive officers in U.S. public companies. And actually this is particularly true in more homogeneous sectors like energy, utilities, and real estate. And it's not hard to understand why. I mean, particularly if you are in that relatively homogeneous industry sector where, industry cycles have this similar effect, right, on all companies. So, for example, TSR plans, we all know, easily defendable. TSR tracks shareholder experience. Relative metrics reduce the, that internal wrangling and uncertainty that often, comes with establishing multi-year financial performance goals. Establishing a relative performance peer group and performance tracking is a lot easier for relative TSR than it would be for a relative financial performance metric like, ROIC or EPS growth. I'll also add, the fact that TSR is the sole performance metric for 2 of the 4 ISFP performance tests is probably also a key consideration for some compensation committees. So, with all that said, now, earning full credit, for that old plain vanilla relative TSR plan, while maintaining incentive value of the awards, we're finding it's becoming more challenging. And the 2 areas are the most common concerns we see regarding our relative TSR plan designs are, first, related to performance standards. So, target payout at median performance is, no longer considered sufficiently robust by the proxy advisors. And then the second, increasing pressure to adopt negative absolute TSR caps, right? So, which, limit the payout when absolute TSR is negative. This is popular with both proxy advisors and shareholder groups alike. Of course, the underlying rationale for the advisory firm position is, hey, if shareholders are losing money, plan participants shouldn't be able to earn an above target payout. And actually, we're going to focus a little bit more on this second concern today. So, faced with this environment and faced with these additional lists of like to have for TSR plans, how do you continue to navigate the advisory firm and shareholder environment, where you might have TSR, but now just having that plain vanilla TSR plan isn't enough if you're going to use TSR. How should you think about your TSR plan going into next year. If you're going to continue with that TSR, what, if anything, should you be doing, to make sure that it continues to work for you without creating, too much, external pushback. So, before I walk through some questions you should ask when reviewing the design and appropriateness of the relative TSR plan, we do have our, we have our next polling question.
Great, Leanne, thanks. And great summary. And before Leanne gives you the answers to all the questions she just raised, let's do this polling question here, because like I said before, TSR has come from nowhere to being part of almost every comp plan that I'm seeing in some manner, shape, or form. So if you have a relative TSR plan, have you had external pressure or feedback to modify it? And the choices are there: none, yes, a little bit of pressure to adopt a negative absolute TSR cap, et cetera. You can read them. Please answer what you're experiencing. And as you're doing that, just an observation for you. We've operated in a very interesting era last 5 years or so while TSR has been adopted by most boards and comp committees. Low cost of capital, for sure, very low interest rates, and tax cuts, so a booming market. Everything is going upwards and to the right. Life is beautiful. One of the things I think we all need to start thinking about, particularly around caps, performance standards, is what happens if that trend of up to the right doesn't continue and it starts to decline. And so there's a retraction in the stock market, in total shareholder return, et cetera, across the board. And you still have a management team and an executive team and a CEO who are working really, really hard and doing a great job, but the numbers in TSR are going the wrong way. What do you do? So let's look at the answers, and then Leanne can provide some perspective on solutions here. So none. Nope. 3/4 nope. There's some to increase performance standards. So very, very interesting. So it will be interesting if we hit a downturn, whether these numbers will change going off into the future. So, Leanne, why don't you talk about some ideas going forward on what we ought to be thinking about for 2019?
Yeah, and I'll react to the response because, in our experience from a market perspective, while most companies may have not yet opted to adopt a cap, we see a prevalence growing, due to this increasing pressure from proxy advisor firms and shareholder groups. So, I guess, if you're not feeling the pressure yet, I think, we'll see some in the future. So that was interesting to see that. Okay, so, the next slide here, we're going to talk about kind of what are some of the questions you should be asking. And let's start with the top. So first, what is the role of TSR in the mix? So with TSR as part of your mix, if you make additional modifications, so for example, like a cap, a collar, raising performance standards, ask the question, are you going to end up diluting that incentive value of these awards or diluting what it was you were trying to accomplish? Do you already have, absolute performance measures elsewhere in your pay mix? In your TSR award, for the vast majority of companies, well, you're not operating in a vacuum. You have salary, annual incentives that have absolute goals in it. You may have restricted stock. So, getting back to those negative absolute TSR caps, which are popular with proxy advisor shareholder groups, if you then, cap those awards at 100, right? So capping the number of shares when the stock price is down, even when you have outperformed in an industry that is down, you risk, double penalizing the management team for all the work they've done to preserve shareholder value during a time when, you may actually really need them to be working the hardest. So, it dilutes the incentive or it caps an incentive that can be particularly powerful when you need it most. So with that said, are there alternatives to the absolute cap, that will address both proxy advisor, shareholder group concerns, while also addressing, the perceived value concerns of the participants in the plan. And one quick example, before I dive into alternatives, I wanted to mention, this is not necessarily true of all industries, but in the oil and gas industry, over any 3-year period, you've got about a 40% chance that you're going to be negative. It just goes up and down all the time. So putting an absolute cap like this in, while it doesn't have a lot of impact on the Monte Carlo valuation, for most companies, it can actually have a really a large impact on the perceived value of the plan for the people who are in it. For example, one client for 2 periods in a row got capped after performing above the 75th percentile against their peer group, and management basically has just about had it with the plan. Okay, so with that said, some alternatives. We've listed here is a TSR collar, which is where you have the cap for negative TSR, but then also you have a floor where you can at least earn threshold or some fraction of target if you are sufficiently positive over the same period, regardless of what your relative level of performance is. So for example, if you're above, say, 20% annualized return, you're not going to go any lower than 25% of target. You'll get something. Now, a huge caveat here, you have to be careful with that because if you set that floor wrong, for example, you set it at target, you could get cited by the proxy advisory firms for this. So again, just be careful how you set this up. Another way you can do this is a matrix. So it's a little bit more complex than the collar, but you get to establish, call it multiple payout curves that are dependent on which range you fall in for absolute TSR. So depending on what range of absolute TSR you fall in, you'll have a different opportunity. If you're negative, your payout opportunity could be like half of what it would be otherwise. If it's positive but not super positive, you get a regular payout schedule. And if it's above a certain level, then maybe you have a little bit of an additional kicker when you hit both pieces out of the park, meaning absolute and relative TSR performance. So those are just two alternatives to consider. Of course, there are others. But the final two kind of questions next, has the payout schedule been properly calibrated? So important to note, any modifications that you do will have implications for expected and reported value rewards. So the important thing to take away from here is you just want to make sure you calibrate where you have those payout levels, you do the right amount of testing of these designs, alternatives, and see what implications you have for the expected value of the awards, especially if you're using fair market value on the data grant to determine the number of shares, which most companies do anyway. But again, you could really end up granting significantly more theoretical value and also likewise a lot less than you intended to if you're not watching it closely. So again, just to make sure you're watching this and being careful there. And finally, as you step back, assess your plans. Maybe what you already have is working well, maybe it's not, but wanted to say this last reminder. We start off by saying relative TSR plans are not going away. There are shareholder groups that like them. They work well in certain situations. But having said that, at that certain point, you feel like you're jumping through too many hoops to be able to use a relative TSR plan, maybe it's time just to get rid of it. Maybe it's time to look at the good old-fashioned absolute TSR award of stock options, or even looking at absolute financial performance in your long-term incentive plan. So just watching the clock, but going to pass the torch to Deb to talk about non-financial metrics.
Thank you, Leanne. And I feel like here we're going for a complete and quick 180 from the hard stuff, from stuff that's like very measurable and very ISS-driven TSR to the softer non-financial measures. And this is really a perfect year to be talking about this because if you think about it, we're on about the 10th or 11th year of Say on Pay. Back when we saw our first proxies with Say on Pay, we were very concerned about incorporating financial measures so that shareholders voting on our compensation plans could see the tie between pay and performance very, crystal clear. We had 162M boxing in at least our named executive officers. You never wanted to veer away from an objective, pre-certified and formalized payouts based on financial measures or, measures that were clearly objective. And as the CDNA developed, we see an opportunity to have explanations and get away from purely driven financial goals because you can explain them. And we're seeing more and more CDAs that develop like marketing documents rather than financial documents to explain why you need to push strategy and measures that are important to your company that may not be financial. And we have a quote in here from Larry Fink, BlackRock, because committee members typically turn and read this letter, and you can see he's focusing not only on stakeholders, but what's the larger impact on employees and customers and communities as a whole. And, a lot of companies got a fantastic corporate tax influx of currency last year, and the idea is maybe you shouldn't be just returning it to your shareholders, but doing something that ties the strategy of the company to good for all. but either in terms of environmental, social, and governance, or strategic development looking further down the pike. So how are we doing this? We've seen that people are focusing on it a lot more at the committee level. In our own survey of our clients, we found out in reaction to a question whether or not they're focusing on non-financial goals, at least in their short-term payments, 48% of people came back, of those surveyed came back and said yes, which is a very high number. We're not sure if that number is really a number tied to a certain percentage of the incentive payment, or if it's just under consideration or maybe a modifier to the financial results. But nonetheless, it's clear that it's on people's minds. The trick is, of course, how do you implement a non-financial measure? Sometimes they're so elusive or hard or nuanced, it's really hard to put numbers around it. And also, some of them are really about forward-looking than backward-looking. The problem with financial measures and ISS, all of their tests are backward-looking measures. They're lag measures because we're looking backwards in time and we're seeing where our finances are at the time. When we look at a lot of the non-financial measures are forward-looking, they're lead. And so it's a little bit difficult. The balancing act is, satisfying ISS tests to get positive recommendations from them versus focusing on what's strategic for your company at that time. And maybe it is a forward-looking measure. Maybe it is how you employ capital. Maybe it is how your strategic initiatives, particularly in life science and biotech kind of companies. So with that, I think we're turning to a polling question because we'd like to get this audience's feedback about how much weight your companies are putting on non-financial metrics in your compensation program. Here, we're not talking again about just individual performance, but more strategic balanced scorecard kinds of things and ESG goals.
Let's see what the results are. 11 to 25%. That's what I would have picked, and that's what I wrote down when I did the polling question. The pendulum has swung back from all financial to a much better balance of what you accomplished financially, but also how you did it. So very, very interesting.
All right.
Leanne, Deb, you want to talk about some other points on non-financial metrics for consideration?
Yeah. In the interest of time, you have this here, and we won't read it, but some of the things, of course, that are struggles when you're setting up this program is what are the proper non-financial metrics to be considered. You really have to look at your strategy at that time. Is capital deployment important, development of new markets, or customer satisfaction? What's really key to driving the success of your company?
There could be unusual, extraordinary, or special events that warrant consideration of adjustments to goals or adjustments to the way a plan calculates an award. We thought this would be our good final topic for this year. So, starting with the universal point. So, good incentive plan design and good governance around exec compensation program has to include planning for the unexpected. Understanding that things don't always work out the way you expect them to, and you really don't want to ad hoc or make things up along the way if you can avoid it. So you'll hear me say this probably a couple more times along the way, but upfront planning makes a lot of sense. So even in normal times, even for the last couple of years, there have been plenty of events that may pop up that could warrant consideration of adjustments to incentive plans. So just quickly going down, but, for example, there might be some strategic activity that occurs, so acquisition and divestiture. So some of that is planned for, but some of that is opportunistic, and so you want to make sure that your plan can accommodate that. Unusual swings in commodity prices, exchange rates, or any other kind of factors that have a big impact on your business, when they swing outside of planning parameters, they can really do damage to your incentive plans in terms of their ability to incent for performance. Just in terms of time, again, so there's a settlement of lawsuits, but in terms of all of these issues, you just want to make sure you've thought through how you adjust your incentive plans or don't adjust your incentive plans for these events before you start the cycles. And kind of that final bullet point on here, if that's not enough, hey, over the last couple of years, we've had some other things pop up. So, what do we do about trade wars, the impact of tariffs and major environmental events, and the impact of global climate change? How are these things taken into account when they aren't fully reflected in the planning and the numbers in the incentive plan. So, for example, what does it mean when our president says, there's a 90-day pause in trade war, and especially with global manufacturers, tariffs are absolutely wreaking havoc on the planning, and for some of our clients, the numbers are changing pretty drastically. One of our clients is going from near maximum to below target on actual performance, because of these tariffs, and they're trying to figure out, what, if anything, they should do about it. And of course, there's the tax law changes. So, let's go to the next page. So, but now that, we've discussed all the stuff that people have to worry about, let's talk about, what do you do about it? So again, plan ahead. Make sure that you've discussed the potential treatment for all of these cases, and maybe some others we haven't even talked about, at the start of the incentive cycles. And certainly when you start a new incentive plan, what are going to be the rules for how you deal with these unplanned for events? For each of these events, you want to think about a few questions. So starting at the top, is the event unusual or extraordinary? Is it the new normal? As I mentioned before, this is a great question to ask, specifically about the trade wars, and the impact of tariffs. So is this something, we're going to have to live with on a go-forward basis, therefore it becomes business as usual, or is this something that's going to fade away? So either in the next Congress or the next presidency. Second question, what has been done in the past? This is actually really important. What have you done in similar situations in the past? And consistency is something that you want to stick with if other things hold in place. So, this is one principle, just make sure you keep in mind. Third, how might decision-making be influenced by adjustments if they're made or not made? So this really gets to the heart of why you have an incentive plan in the first place, right? So you have an incentive plan to send the right signals and incent good management performance. But if a situation arises where the decision to adjust or not adjust is going to change how people make decisions, you really want to take that into account and make sure that what you're doing continues to incent the right behavior by management. Fourth, what is the magnitude of the event on incentive? So some things might seem important, but by the time you take a look at what happens to the incentive, it might only be, plus or minus a couple of percentage points, or 10, 20,000, and you really want to take into account materiality. So, all things being equal, if you can let something flow through without impacting decision making and without having a major impact on the funding, maybe it's just better to keep things simple and let it flow through. Five, what will be perceived as fair, both to employees, our executives, and to the shareholder base for your company. So, this is important consideration, just obviously, in terms of making sure people believe that the program continues to adhere to its first principles. And finally, what precedent is being set. So, super important, but when you take this action, it kind of sets a precedent. How are we going to be comfortable with this in the future, if other situations like this arise? And, in the last kind of section on this page, during the cycle, just, when you're in the cycle, hopefully you've done a great job in going through all the things that could happen. But inevitably, there will be things that you haven't fully anticipated. And even those things that you have talked about, just make sure you raise them with the compensation committee early and often. Don't wait until the end of the cycle to bring up all the things that you want to discuss with respect to potential adjustments. Decisions don't have to be made during the middle of the cycle. And they probably actually shouldn't be, but the committee should be aware, of the potential impacts of the event, as early as possible, so they have time to consider all these questions that we've just discussed. In terms of the key takeaways, just to be really quick, at the end of the day, we talked about, 2019 is going to be a year for some flexibility, creativity. We're in a state of flux and turbulent times. Just keep in mind, again, we talked about good plan design, good executive compensation governance, includes planning for the unexpected. Try to avoid doing the same old. So again, for a couple of reasons. One, because you can, so the demise of, 162, that's gone away. And also, but because, today's social and cultural norms are really asking you to rethink some of your plans. And of course, super important, take a step back, make sure your executive and director pay programs are really still accomplishing what you want them to do.
Marty, did you have anything else to add?
What I used to do as chair of a comp committee, and also encouraged all comp committees to do, is in the mid-year meeting in July to take a look at the comp plan that you've got in place, what's working and what's not working, and what are the unintended consequences of the plan that you so thoughtfully devised back in December and January of the earlier in the year. And then also have a meeting with, like we would at the audit committee meetings, have a private meeting with the CEO, and then a second meeting with the chief human resource officer and ask them the same questions. What's working, what's not working, and to get a handle on some of the things that might be changing here. And this will become actually more important right now as we go forward into 19, because it's going to be a volatile year and a lot of changes. So with that, Sienna, why don't I turn it over to you for some wrap-up and then other information, okay? And then the questions you can talk about also.
Sure. Thank you, Marty. Audience, I do have a few housekeeping announcements, final housekeeping announcements to share with you before we close today. I just wanted to remind everyone we did get a lot of questions, and we don't have time to get to them before the end of the webcast today, but we will be following up with everyone via email. So you will get your questions answered. If you submitted one, we have it, and we will be following up with you after the program.